Morgan, how are you, man?
Good. How you doing? Thanks for having me.
I'm great. Thanks for coming on. So you and I got to chat a couple weeks ago more about life and personal finance and things like that, and maybe just give folks a quick snippet of your background, and then I want to jump in and talk a little about your book and some other things.
Sure. So I'm a partner at the Collaborative Fund, where I've been for about 5 years, but I have a unique role there. All I do is write and speak, which is all I've ever done for my entire career. I've been a full-time
And you're
financial
good at it.
writer. Well, thanks. I've been a full-time writer since I was a junior in college, when I started writing for the Motley Fool, and I was in the Motley Fool for 10 years. And then I was a columnist at the Wall Street Journal for a couple of years, and then joined Collaborative Fund in 2016 and published a book last September called The Psychology of Money. So that's my quick background. I'm in VC. I'm a partner at a VC firm, but I am and always have been a writer.
Yeah. And what caused you to be so interested in personal finance? Like you have a real passion for, as I told you, I gave the book to my daughter. She loved it. It really resonates with me. I grew up with a dad who was in the finance business, taught me about investing and saving and things like that, and not spending money on credit card interest when I was 15 years old. What drove it for you? Was it growing up, household, parents? What caused you to be interested in personal finance?
I think if you go back to like when I started getting interested in finance, what I was interested in was stock picking. And I wanted to be a banker at Goldman Sachs. If you go back to like my early 20s, that's what I wanted to be, because stock picking seemed really fun. And being a partner at Goldman Sachs seemed like the peak of prestige and money. In the mid 2000s, that's how everyone viewed it, at least. It's a
Yeah,
little bit
that's true.
different today. So my start in finance was that. But then as the years went on and as I aged, and particularly as I just watched and wrote about the financial crisis of 2008, which was like my early years of writing, it became obvious that finance was a much broader field
Hmm.
than the narrow lens that I had viewed it through. I had viewed it through like, oh, let's pick some stocks or make a lot of money as an investment banker. Like that's what finance was to me. And it wasn't until I became an adult and got married and had kids that you realize that finance is so much broader in terms of like your happiness in life, in terms of your ability to be independent, your ability to do like live where you want, work in the job that you want, have enough freedom and control to retire when you want, have good health insurance, like all these things that are very fundamental to just overall happiness kind of center around finance. And I feel like there's two fields that everyone kind of has an obligation to understand and to learn about, whether they like them or not. And that's health and money.
Yeah.
It doesn't matter whether you are interested in health or money, those fields are interested in you. And it doesn't matter what you do in life, no matter what field you work in, those two topics are going to impact your life. So everyone has to learn about those because they're so fundamental to what everyone does.
But we
And
don't
so
really
that I was
teach
really
those in
interested in
school.
that. We
That's what
don't, and
drives me
we don't
nuts.
teach those in schools. Those are like the
Yeah.
two things that we don't. And like one other topic in there is like how to be a good spouse, how to be a good partner. That's the like how to be a good spouse, health and money are like the three fundamental building blocks of like adulthood. And this is the things that we don't teach in high school.
Yeah. I feel like I'm pretty good at one. Health, I'm getting better at, and being a good spouse, I'm doing my best. But why don't you? I mean, we're in an age where people are talking a lot about income inequality, a lot of focus on the fact that we have people like Elon Musk and Jeff Bezos who are fabulously wealthy, and then we have tons of people in our country who are struggling. Why isn't? And I'm just wondering if you've looked into this. Why isn't there a push at the federal or state level to say, God damn it, we got to start teaching people in high school and college about money and how to manage money and save money and plan for retirement? And why is it just because government wants to take the shortcut and not deal with the systemic issues? Because by the way, I have the same question about like jobs, and it like why we don't teach computer science in California is bewildering to
Yeah.
me. But
Yeah.
I'm just curious, why hasn't there been some sort of broad-based effort to teach people about money and finance?
There's
In your
probably a
mind.
couple reasons why, and these are not excuses; these are just like explanations for why it happens. I think one is that there's just so much momentum in curriculums that the things we teach today are the same topics that we were teaching in the 1950s and the 1930s. Like things are very slow to change, and that's really important for finance because the whole idea of everyone, no matter what job you're in, gets to retire at age 65, and you have to save and invest to fund your own retirement. That whole concept is like 30 or 40 years old.
Right, right,
Like
right.
before the 1980s, the idea that an average person could retire off of their stock holdings was reserved for a tiny sliver of
Hmm.
wealthy people. Before about the 1960s, the vast majority of people just worked until they died. that was the expectation. The idea of retirement wasn't there. So for most of our history, the idea of teaching finance didn't really matter because finance wasn't really impacting most people to the degree that it does today. The huge majority of Americans were paycheck to paycheck and work until they died. So financial education, and also there's been such a proliferation of financial products available to everyday people in the last 20 years. So if you go back to the 1980s, teaching people how to invest in the stock market, teaching average ordinary people
that
in
wasn't
high
happening.
school how to invest, it didn't matter because unless you had $1 million and you could go get an account at Merrill Lynch, you weren't going to invest anyways. So it just didn't matter. One other explanation, not excuse, but explanation, is that a lot of finance is subjective in a way that algebra is not. Like if you are a high school finance teacher and you tell all your students to open up a Robinhood account and place 10 trades a day, are you teaching them finance? Like, yeah, but is it good? Like, no, it can be horrible.
Yeah.
So I think most of what is taught, they only teach topics that are not subjective. I think there's some variance in there, and like history, like there's parts of history that are subjectively taught and whatnot. But I think that's one of the challenges as well. And then the third explanation, it's not an excuse, but I think it's just an explanation, is that so much of teaching finance has to do with social economic class of like where you stand. And if you have a diverse high school class of very well students and very poor students, then those students' goals and outlook and whatnot are going to be very different in a way that, again, that they're like teaching them algebra is not different for those students, but it's very different. Even the teacher who's teaching it has a very different view on the world of how the stock market works and whether debt is worth it or not, et cetera, in a way that just makes it hard to teach. So I desperately wish it was taught, but I think if there is an explanation for why it's not, it's probably something like that.
The curriculum point's a good one. I actually met with the principal at our high school a couple of years ago and said, hey, how could we get computer science into the curriculum? He said, you got to change the state testing. Because if we don't test for it, we don't teach it. And he was like, that's the only way you're going to make this change is if we change the way what we test for, then I can change what we teach. But he said until that happens, it's very systemic and it'll take a long period of time.
I mean, it takes so long. I mean, one other example of this is like they still teach long division by hand.
I know.
And I think the reason that they do that is because they were teaching that in the 1930s before calculators. And it just keeps going. It just keeps going.
I know.
So it's like, I don't have that much hope for change in that area because it takes so long to get new stuff in.
It's funny. My son, who's 10, he asked me, he said, Dad, I know you do math in your job. Do you guys do long division? And I looked at him, I was like, I mean, obviously, no, we use spreadsheets and, we don't use calculators anymore, but we use spreadsheets. And so it's like, why aren't we teaching them that? Anyways, enough of that. So your book, you sit down, you write this book. Tell me about a couple things you learned from writing the book, because the book I think it's super cool the way you wrote it. Maybe tell folks the way you wrote it and some of the things that you learned from it.
Well, here's, some background about it. Since I've been a blogger for 13, 14 years now, most blog posts are about 1,000 words. If you're not familiar with the length, like that's a normal length blog post, 800 to 1,000 words. And so a book chapter in a normal book would be 3,000 to 5,000 words. It's kind of like a normal chapter length for a book. So that was my goal. When I sat down and structured the book, I thought, okay, 10 chapters, 5,000 words, let's go do it. And I realized after digging into this, that my specialty, because I've been doing it for so long, is 1,000 words, maybe 1,500 to 2,000 words. That's what I do. I've been doing that forever. I'm comfortable with that length. I know how to write in that length. So as I sat down and said, okay, now let's do a 5,000 or 7,000 word chapter, I realized it's a totally different beast. And even if I'm confident in my writing, it's a totally different thing to do.
Yeah.
And so as I kind of chipped away at it, I finally just embraced that, like, no, I'm a short form writer and I'm not going to do 7,000 word chapters. I'm going to do at most 2,500 word chapters, which I'm still comfortable with that length. So I kind of threw out the playbook and I said, no, rather than 10 long chapters, this book's going to be 20 short chapters because I'm comfortable with that. And what's really important to me too, is that I'm a big reader. Lots of people listening to this are read lots of books too. I rarely finish books. Maybe 1 in 8, 1 in 10 do I read to the last page, if that even, because the huge majority of books just make a good point and then just fill the rest with fluff.
Yeah.
And I wanted to avoid that as much as I can in this book. I'm not saying there's no fluff, but I wanted everything to be really succinct. And so I wanted to do that with short chapters. Here's the point I'm making in this chapter. I'm going to tell a story, make my point, and then I'm done. I'm moving on to the next chapter. And there's one chapter in the book that is 1 page long. And when I turned it in, the editors were like, is this a mistake? Are you forgetting something here? Did you leave something? And I said, no, that's all I have to say on this point. it's a good point that I want to make. I'm proud of this point, but that's all I have to say. I'm done. I'm not going to waste anyone else's time. Move on. So the metric that I want to, I'm really interested in, there's no way I can track this, but how many people who start the book finish it? Again, there's no way I can track that, but that's what I wanted to accomplish for this book. I just want to make it really easy to read and succinct.
And what are, like, for folks who haven't read it yet, what are a couple takeaways that you've either heard from readers or that you had in writing it? You know, what are like the high level, give me 3 things that, like, okay, if nothing else, I hope you take away this from reading The Psychology of Money.
One is that we're all totally different. And we tend to teach finance, to the extent that we teach it, like it's math, where 2 + 2 = 4 for me and you and everyone else. There's one right answer in math. And investing in finance is just not that at all. It's a very personal endeavor where people who have the same education, the same information, can come to totally different conclusions about what they should do and what's right. Not just with the investments that we make, but what's the right savings rate? What's the ideal target net worth? How should you, and like, everyone's going to come to different answers for that. And a lot of times in investing, when we have a debate, if you and I are arguing, is this stock worth it to buy? Yes or no? A lot of times we're actually not even debating. We're just realizing that we're playing different games and we're talking over each other.
Yeah.
So just, you know, this is not the case for you and I, but let's say you're a day trader and I'm a long-term investor. Again, I'm just making that up. Then we could be having a debate where you're like, you have to buy Netflix. And I say, no, Netflix is a bad buy. We don't actually disagree with each other. We're just playing different games. So it's really important in finance to just understand what game you're playing and realize that if other people are playing a different game, you don't need to take your cues from them. You don't need to follow them. You don't need to debate them. Just do what works for you and embrace that. I mean, that's one big one. The other is that a lot of the really important foundations of finance, like compounding and investing, a lot of like the really basic stuff, are not intuitive. It's not that they're overly complicated. It's not that. It's just that they're not intuitive. Our first line of thinking, our snap reactions don't actually reflect how these things actually work. So even very smart, educated people who understand the math of compounding and can explain it to you all day and know the math, they often overlook how powerful it is in explaining outcomes. I mean, the example that I give in the book is Warren Buffett's net worth is $90 billion. 97% of that came after his 65th birthday.
It's incredible.
Which
I heard you make that point. It's such an incredible stat.
And that's how compounding works. And what's really important about this is that if Buffett had retired at age 65 like a normal person, you would have never heard of him. He never would have become a household name. He would have retired to Boca Raton to play golf with a couple $100 million like dozens of other people there have. The only reason he's so successful is because he's been investing from age 10 through today at age 90. That's it. It's the time he's been investing for. And if you go onto Amazon, there are like 2,000 books that devote to trying to answer the question, how did Buffett do it? How did Buffett achieve this success? And they go into detail about how he thinks about like moats and business models and market cycles, when the real explanation for why he's done it is just time. He's been investing.
He's not even the greatest stock picker. I mean,
not even close. People like Jim Simons and whatnot have average annual returns that are much better. Buffett's annual returns are phenomenal. Don't get me wrong, but the real secret is just that he's had really good returns for 80 years. That's the big takeaway. By
the way, have you read the book on Jim Simons, The Man Who Solved Markets? It's an incredible book. What I think his compounded annual return is like 65%.
65%
over 30 years.
For 30 years, something like that. It's in a completely different universe.
So I love that point about everybody being different. In fact, when I tweet out things about investing on Twitter, people are like, "Oh, it's terrible advice." I'm like, I don't love giving advice because everybody's different, right? For me, when I'm talking to people who are 23, 24, 25, and they say, "Hey, thinking about buying GameStop," and I'm like, "Look, if you want to have some play money to take big risks, sure, but buy QQQ, buy WCLD, buy some things that just get you in the market and just keep investing." That point about compounding, and by the way, I don't care what you buy the S&P 500, buy whatever, but just be in the market, right? From the time you're 23 until you're 55, if you do that for 30 years, unless our economy falls off a cliff, you're going to start to benefit in a big way from that compounding. And I think what I see with a lot of folks is they overthink it. They're like, "Oh, what should I buy? Which stock should I?" I'm like, just buy something. And this is a little bit of the beauty of what Andy Ratcliffe has tried to do with Wealthfront, right? It's not perfect, but he's basically said, just put it on autopilot and get into a mix of stuff that works for you. And over time, you will make money. And don't come in and out. Don't try and time the market, right? I had a good friend of mine, you and I talked about this, good friend of mine called me in February of last year. He's like, "I'm out. I went all cash. Market's cratering under COVID." And then of course I talked to him in like June or July and I'm like, did you get back in March? And he was like, no.
Yeah. And that will leave a scar on his net worth that will be around forever. You can't recover from
Totally.
that. The point
Totally.
about not being perfect though is really important, because once you look into compounding and kind of dig into how it works, you realize that what's important is not how can I earn the highest returns? That's not the question that's important. The question is, what returns can I earn for the longest period of time? That's where you're going to earn the insane amount of money over the course of your life.
Yeah.
So then to me, the question, like the North Star that I want to track and really, guide towards is how can I have endurance and what can I stick with through thick and thin? And for me, and I emphasize for me, I'm not saying everyone should do this or anyone else should do this, but I'm a fairly passive investor. But it's not because I'm not a passive zealot. I'm not one of the people who say no one can beat the market. I don't believe that at all. I feel like a lot of smart people can and do. But for me, if I had a less passive approach, if I had a more active approach to my investing, it would increase the odds that I would not be able to stick with it over time, because I would lose faith. I would lose faith in a manager, or because some sector would go through a 10-year drought like they always do, and I might lose faith in that. And if I lose faith, I would interrupt my compounding. So passive, I know, is going to earn lower returns this year than a lot of other smart managers, but it gives me higher chance of sticking with it for the next 50 years. And if I can do that, if I can stay in my passive strategy for 50 years, I'm going to achieve every financial goal that I have times 10. So why would I want anything else?
And that was something
that's how I think about it.
You talked about that on, I think it was on Patrick O'Shaughnessy's podcast, which was awesome. And I recommend people listen to, but you've sort of lined up all the ducks in your life around, I'm a passive investor. Here's how I'm thinking about my mortgage, where I live. Can you talk a little bit about that? Because I think part of getting people comfortable with having an investing and finance strategy is also understanding that it's all tied together, right? What do you want to do for work? Where do you want to travel? Do you not want to travel? Where do you want to live? Do you want to, be married with kids? Do you want to pay for your kids to go to college, not go to college? All those things are tied together with how you manage your money. Can you talk a little about how you've thought about that personally? Because you've been pretty open about it.
Yeah. The last chapter of my book is called Confessions, where I kind of open up the kimono of my wife and I's finances. So there's no numbers, there's no data in there, but just like, here's how we think and here's how we invest. And a lot of it, all that we want is independence. It's not that I don't like working with teams or not. It's not like that at all. But I want to I just want to wake up every day and know that I'm doing what I'm doing today because I want to do it, not because someone else is making me do it on their schedule for their benefit. I'm doing it because I want to do it. I feel like I'm really fierce on that level of independence and autonomy. And I want to use the level of savings and net worth that I've built up to achieve that independence and autonomy.
And by the way, that's what most people want.
But they don't know it.
But they don't know it, and they don't know how to get there, right? Yes. So I think you also have a little bit of a Zen, like it's not like somebody handed you $10 million or you're making $10 million a year as a VC. You've just been very intentional about how you live your life and how that connects with your financing strategy.
Yeah. So we're fairly frugal. We have a high savings rate. We have a good life and a good house, and we it's not like we're living like monks, but we have a pretty good savings rate because we just want independence. I just want to be able, and the other thing is not just independence, like right now, day to day, but I want to make sure, just as a student of history, I know that history is a constant chain of surprises and setbacks and pandemics and recessions and terrorist attacks and world wars. Mm-hmm. And what kind of fools would we be to think that next 50 years, it's not going to be the same?
No.
And even more foolish to think that it's not going to apply to me and you individually. So I want to make sure that I have the endurance financially, the durability financially to survive a catastrophe that I can't even imagine today, whatever that is. Mm-hmm. Medical emergency, Great Depression too, pandemics, divorces, these things that no one wants to think about, but they're realities of how life works. I want to make sure that I can endure those. Because I want the independence. I don't want a catastrophe to dictate how I live my life.
Yeah.
And that's what a lot of it for me. So if you look at my finances, some people might say, oh, you're conservative. My level of cash, as a percentage of my net worth, it's not crazy, but some people might look at that and say, why don't you invest that? And to me, it's not conservative. It's not that I don't want to take a lot of risk. It's that all that matters to me financially is independence and durability. I just want to make sure that I never get kicked out of the game.
Yeah. And are there books or people that you think highly of that have informed your way of thinking along the way? Anything you could recommend that other folks pay attention to or read beyond your book?
There's a blogger who really kind of created a revolution about a decade ago, who goes by the name Mr. Money Mustache. Some people love him. Some people have never heard of him. He has a silly name, but it's this
Does
guy
anybody
named
know
Pete
who he
Adney.
is?
It's this guy named Pete Adney. He's phenomenal. And he is one of like the founders of the FIRE movement. He retired at age 30 with 600 grand that he figured out how to live off of that for the rest of his life and live a
Wow.
good life on it. Like that's the thing. This guy's not living in a tent. He shows you how to live a great life on this. It's so phenomenal. And he has a great blog called Mr. Money Mustache where he walks you through it. And he would say too that it's not a finance blog, it's like a life philosophy blog. And that's so he's been really really instrumental. I'm not going down that path of living, quite like that. Like he kind of pushed the limits of it. He would disagree with that, but that's how I view it. But just his overall philosophy of like you can live a great life on less than you think was really influential to us, because for most people, including myself and my wife, if you said, oh, you can live a great life, but you're going to need to sacrifice. You're going to need to live in a shack out in the woods with dirty clothes, no more vacations. If you tell people that, they're like, I'm not interested. But if you show them how you can live a great life on less than you thought, people are like, oh, if I don't need to make a sacrifice, but I can retire 20 years sooner than I thought. Well, that's great. Like sign me up for that. So that was really influential. And I think the other that's just like really well known, I know I'm not, saying anything new here, but books like The Black Swan and Fooled by Randomness, you can say a lot about Taleb. He's a jerk online. I think his personality is prickly to put it nicely, but I do think he's a phenomenal thinker and like modern philosopher about risk. And that's had a big impact on me too. This is how I think about the risk of unknowns and the future catastrophes and the day-to-day value and payoff of durability. That's hard to measure. It's not an interest rate that you can say like, because I'm durable, I'm earning an extra 10 percentage points this year. It doesn't work like that. But when you need that durability, like last March when the world is falling to pieces, or 2008, when you need it, you realize that all the conservative investments that you had for the previous decade actually had this enormous payoff in the future when you needed them.
Yeah.
So that had a big impact on me as well.
I think the one thing as you're talking that's really interesting to me is, a lot of folks think that there's a whole bunch of people out there that are way smarter than they are, that are doing way more research than they are, that know much more about the market than they do. And as somebody who's friends with, quite a few folks in venture and hedge funds and private equity, a lot of it is people just relentlessly focusing on investing. Right. And they're like, look, I'm going to get some wrong. I just sold a position today that I lost my ass on. I've owned it for a few years and I was like, okay, it just didn't work out. I was wrong, but I was right on a bunch of stuff in March of last year as well. And I think there's a little bit of this mystery that people have, like, oh, Morgan, he must know a whole bunch of things that I could never learn about finance. You know what I mean? There's this like, oh, well, if I'm not Peter Lynch or Jim Simon, then what's the point? And it's not. I think that part of what I hope people will read your book and understand that's not really what it's about, right? The market is open and you can invest, and you may not have the 65% for 30 years that Jim Simon says, but read the book. The guy also, he's an interesting guy. Like, I'm not sure I'd want his lifestyle either.
That's right? Such a good point. Warren Buffett too is another example of so many people idolize him, but when his biography came out a decade ago, it's called
Snowball.
You realize
great book.
He does not have a charmed life.
No.
He's had a lot of his personal life is not desirable, to put it nicely.
Yeah.
So I think there's a lot of that too. I forget who said this recently, but it really stuck with me that when you are idolizing someone, you can't have just parts of their life.
It's the good part.
You can't say, I want Elon Musk's net worth and I want Bill Gates's house and I want Kim Kardashian's fame. You can't do that. You have to take if you want to be that person, you have to accept all of their life, the pros and the cons. And once you realize that, you kind of stop idolizing people because you just realize that no one has it as good as you think that they do. All these people that you're looking up to, whatever their life is, they might have great lives, but it's not as good as
Totally
you
agree.
And once you realize that, you start, I don't want to get too philosophical about this, but once you realize that, you start just being like, let's just be grateful for what I have. I'm going to stop being jealous of other people because they have downsides that are easy to overlook.
It's funny. I was in Tahoe 2 years ago with an entrepreneur, and we're sitting there having a beer, and he looks at me and goes, hey, Jeff, you've got 4 kids, you're happily married, you got a great job. Looks like you've got it all figured out. I was like, I go, dude, nobody's got it all figured out. I don't care who you are, right? Warren Buffett, Jeff Bezos, me, you, we're all, and I said, like, on the topic of kids, it's a total shit show. Like we're all trying to figure it out as we go, right?
Yeah,
And
yeah,
and
yeah.
I think once you kind of understand that, it lets you relax a little bit. And investing, I think it's the pressure of I have to get it right. And I think what's great about your model is you don't have to get it right. Just be in and do what works for you with your lifestyle. And over time, the power of compounding will create the level of wealth that you want, as long as you're, in my opinion, as long as you're disciplined about it, right? You got to keep investing. A lot
Yeah.
of people get over their
See,
skis on burn, you
that's
know.
the big point. I would say the one thing that I have to get right and everyone's to get right is the time in the market. And that's a hard thing to get right because you have to stick with it through all the ups and downs. And the ups and downs can be mentally torture. 2008, March of last year, I write about long-term investing for a living. And March of last year, I remember waking up at 2 a.m. going, oh shit, what's going to happen now? When is this Great Depression 2.0? Is it worse than the Great Depression? Is this the kind of thing where like Germany in the 1920s, where economic collapse leads to Hitler? Like what are we facing right now?
Right.
It's very easy when everything is going well to say, I'm a long-term investor for the long-term compounding. It's in those moments like last March where that's where it really, where you realize it's easier to quote Warren Buffett than it is to be Warren Buffett. Like when you're actually in the trenches
Totally.
of economic terror, it gets really trying. So
One,
when people say all you have to get right is the timing, well, that's hard to do.
right.
Like sticking it out for the long run can be really difficult.
One thing I hope people learn from 2020, and I learned this from 08, 09, because I remember sitting on the floor of my office in 08, 09, and the market's cratering. I remember AIG went from like whatever, $120 to like $2. And you have this like panic, right? And there's literally shows on TV that are like financial panic, and you're watching them, and you're going, oh my God, the world could end. But it got better. And the next 10 years were the greatest bull market we've ever seen. And so what I learned from that, and this helped me with investing in February of March of last year, because I invested a lot in March, I knew it was going to get better. And I hope people learn from last year that, we don't know the timing. Most economic rebounds don't happen in 90 days, right? It could have taken 9 years, but at some point it will get better. And if you're disciplined about investing, and again, unless the economy falls off a cliff, you're going to be okay, but sticking with it is hard.
Yeah, it's harder than you think, because look, if you ask me, or if you ask someone today, hypothetically, how would you feel if the market fell 30%? Most of what people do is they imagine the world being exactly as it is today, except stock prices are 30% lower.
That's not what happens.
Everything is the same but that's not how it works. The reason the market falls 30% is because something is going on in the world that is testing people's patience, and it'll probably test your patience as well. September 11th, 2008. COVID-19, these things that have, particularly something like COVID, where last March, it wasn't just economic worry. It was, are my parents going to survive? Am I going to survive? I remember last March, I'm sure millions of parents had the same thing. Before we knew that COVID was less dangerous for children, I have 2 young kids, age 5 and 1. And last March, my son got a fever and I panicked.
Yeah.
Panicked. And you can't realize what that feeling is going to be like preemptively. It's not until you're dealing with it that you're like, oh, okay, this is a big deal.
Yeah, I do think that was one of the things that was really hard about last year. It was not only a financial panic, which was 08, 09, it was a health panic and fear of the unknown. We didn't know. It was very scary. And then I had my son test positive, ended up being a false positive. But I just remember in that moment, there's so much that runs through your head of like, because I'm not a doctor. It was a very scary time. And,
yeah, I remember one other person, and I think we all have a story like this. I know I'm not unique in this, but I remember talking with my wife last March saying, what if what if my wife or I get it? What do we do? Because I don't want to be in the same house with our kids, because most viral illnesses affect kids worse. They're more dangerous for kids. COVID's like, we got lucky with that. So my wife and I said, if one of us gets it, I think we're going to move into the car in the driveway, because I don't want to be in the house with the rest of you. So what's our plan? I think I would grab a sleeping bag and go shiver with my fever in the car. Just the fact that was our plan is just, again, I know this is the same for everyone, just highlights like how scary that month was for people.
Well, hey man, I want to be conscious of time. I really appreciate you taking the time. I love what you're doing, and I hope we can find a way to work together on this idea of spreading the gospel of helping people understand more about finance. But I hope people watch this. I hope they take a few things away, and I hope they read your book, because I've given your book to several folks, and they've all told me it was super helpful. Partially because I think they were expecting to read the book and be like, oh, there's a secret and I didn't know what it is and now I have it. And I think when they read the book, it's like, it's not a secret. It's just, being smart, disciplined, dedicated, and stick with it over time.
I mean, the last thing I'll say here is that a lot of the finance industry has made you think that there's a secret.
That's such a great
charge
point.
higher fees to say that if you pay this fee, I'll tell you my secret. There really is no secret. It's just
that's such a great
spend
point.
less money than you make, save the difference, and invest it for the long haul. That's the secret.
Awesome, man. Thanks for the time, Morgan. Appreciate it.
Thanks, Jeff. Thanks, everyone.
All right. Take care.
Bye.